Hello, I'm Pete Doran. Welcome to Brokers Open. It's no secret the United States is experiencing the highest inflation rate we've seen in 40 years. Several factors have contributed to the run-up, including record low interest rates, COVID stimulus, oil prices, supply chain issues. Everything has gotten more expensive, and residential real estate is no exception. Housing prices are up 40% since 2019. Here's Federal Reserve Chairman Jay Powell addressing the issue.
I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place and housing availability and credit availability are at appropriate levels.
So what can Jay Powell do? Well, the Federal Reserve controls the Fed funds rate. This is the rate banks charge each other overnight. This serves as a benchmark for all other interest rates. A change in this rate affects prime rate, bank card rates, auto loans, etc. But it also influences the rate banks pay on deposits like savings accounts, CDs, or money market accounts, for example. But more importantly, it affects the rate the United States government guarantees they'll pay to investors over a given period of time on Treasury securities. And we'll come back to that in a bit. So when the Fed lowers the rate, it increases the money supply, encourages borrowing and spending, and therefore stimulates the economy. When the Fed increases the rate, it decreases the money supply, discourages borrowing and spending, and usually results in a recession. You can see the dramatic drop in the Fed funds rate in early 2020 in response to the pandemic. In fact, the rate was effectively dropped to near zero to stimulate the economy. So getting back to those Treasury securities, we're going to focus on the 10-year Treasury note. It's the 10-year Treasury note that has a direct effect on mortgage rates, particularly the 30-year fixed-rate mortgage. The 30-year fixed is America's favorite type of mortgage. 90% of homeowners choose a 30-year fixed-rate loan. And no wonder why. Just ask Warren Buffett.
If you get a 30-year mortgage, it's the best instrument in the world, because if you're wrong and rates go to 2%, which I don't think they will, but you pay it off. I mean, it's a one-way renegotiation. I mean, it is an incredibly attractive instrument.
So the 10-year Treasury matches the typical maturity of a 30-year loan. See, even though most people finance a home with a 30-year loan, they don't usually stay there for 30 years. On average, they stay about 10 years, sell, and then pay off the balance of the mortgage. That's why the 10-year Treasury rate is the index that mortgage bankers use to price the 30-year mortgage. They take the 10-year rate and add a margin, usually about 1.5% to 2%, and that establishes the 30-year mortgage rate at any given time. You can see how they move together over time. So we've gone from about a 3% rate on a 30-year fixed to about a 6% rate since January, and there's every indication that it could go even higher. When you consider the recent increase in home prices along with a doubling of the mortgage rate, you've got a 1-2 punch to affordability. Check out this CNBC clip with Black Knight's VP of Enterprise Research, Andy Walden.
Let's say mortgage rates, this is the peak. Does the market then, you think, fix itself? Or is this level? I mean, it has to come down.
Well, I mean, the way that it fixes itself is one of three ways, right? It waits for incomes to grow to kind of normalize and kind of bring us back into balance. We would need 40% income growth at where prices are right now to get us back to a long-term level of affordability.
40% income growth.
Or zero, yeah. Or interest rates coming down closer to that 3 to 4% range, or prices continuing to pull back, right? So I think it's one of those three things that brings us into balance. But the market just simply, where prices and incomes are at right now, it's just simply not built for a 6% rate environment. And That's what you're seeing take place out there. You're seeing the market choke on those 6% rates based on where incomes are right now and where home prices are right now.
So the Fed is raising interest rates to try and cool down the economy and the residential real estate market. But will it work? Here's Jay Powell again.
Rates have moved up. We're well aware that mortgage rates have moved up a lot, and you're seeing a changing housing market. We're watching it to see what will happen. How much will it really affect residential investment? Not really sure. How much will it affect housing prices? Not really sure. Obviously we're watching that quite carefully.
Well, Jay seems hopeful that it will work. But what can we learn from history? Well, the last time we had inflation like this was the late 70s, early 80s. By the summer of 1980, inflation was near 14.5%. The chairman of the Federal Reserve at that time was a gentleman named Paul Volcker. Paul Volcker famously tamed inflation, but at a great cost. Had 2 back-to-back recessions, high unemployment, stocks crashed, interest rates oscillated, and for a while, bonds looked shaky too. At one point, Volcker raised the Fed funds rate to nearly 20%. In turn, the average mortgage rate in 1981 was just over 16.5%. In October of 81, mortgage rates actually reached 18.6%. That's the highest rate on record. And by the way, that's 5 times higher than the average rate we had in 2019. So is Jay Powell channeling Paul Volcker?
The successful Volcker disinflation of the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was ultimately needed to stem high inflation and to start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now.
It seems that Jay Powell is intent on following the Volcker playbook. So what happened to residential real estate in the 80s? Well, you may be surprised to know that real estate prices actually went up in the early 80s and through the end of the decade. The prices didn't crash, but the volume sure did. The number of homes sold per year fell dramatically, actually down 50% in 1982. And incidentally, that's the year I graduated from college and got into the real estate business. It's interesting because what you had to do back then was creative financing to put a deal together. That's the only way you could make a deal work. So there was owner financing, land contracts, assumptions, wraparound mortgages, lease options. Somehow we made it work. Because no matter what the market conditions are, people always need to buy and sell residential real estate. Life goes on, and it's up to the real estate professionals to adapt. That being said, creative financing is destined to make a comeback. I'll probably do a video on the ins and outs of creative financing here in the near future. Anyway, take a look at what real estate has done through all the recessions we've had since 1970. You can see prices have moved mostly sideways and up in every recession, with the exception of the Great Recession of 2008. In the Great Recession, prices fell 33% in 2010 nationally, and the number of homes sold dropped to just over 4 million a year. And that was from a peak of 7 million in 2005. And by the way, foreclosure filings in 2010 exceeded 3 million. Now, on a side note, for the first half of this year, foreclosure filings were just under 165,000. That's right. So when you see a headline, foreclosures are up 160%, well, compared to what? Compared to last year during a moratorium with the lowest amount of foreclosures in recorded history. Now, here's a chart from Atom Data showing foreclosure activity for the first half of each year going back to 2008. So context is everything. And as they say, figures lie and liars figure. So what caused the mortgage crisis leading to the Great Recession? Well, it was a toxic combination of lax underwriting, exotic mortgage products, deregulation, and some serious shenanigans in the investment banking community.
Where's the trash? Behind you. I'm talking rock bottom FICO scores. No income verification. Adjustable rates. Dog shit.
You get the point. It's safe to say the surge in real estate prices in the mid-2000s was caused by easy money. We'll take a look at this. This is the Mortgage Credit Availability Index published by the Mortgage Bankers Association. Essentially, the higher the number on the vertical axis, the easier it is to qualify for a mortgage. Now look at the levels in 05 and 06, and then the drop. Now back in 05 and 06, they had a mortgage product for everybody.
I have 5 houses and a condo.
Well, when then the party was over by 2008, underwriting standards got really tight, and they've stayed that way ever since. So if the run-up in home prices in the mid-2000s was a byproduct of easy money, you could say the surge in real estate prices we've seen recently is a byproduct of cheap money. But it wasn't easy. Only the most qualified buyers could get it. Existing mortgages are extremely well underwritten. The rates are way under market. And if homeowners are having trouble making the mortgage payment, a vast majority of them can sell and pay off the balance. So if your brother-in-law is hoping for a massive wave of foreclosures, tell him not to hold his breath. So can Jay Powell reset the real estate market?
Not really sure.
He's giving it a kickstart. The number of homes sold is down significantly, and prices are edging down in some markets. But it's doubtful he can do it alone. So going forward, how do we solve the affordability problem? Well, maybe it's a combination, a trifecta, if you will. Wages could increase 10-15% over the next 18 months. Let's say median home prices correct down 10 or 15%, and mortgage rates settle back in around 4.25%, 4.5%. That could work. So what do you think? Well, thanks for sticking around. If you like the content, please like and subscribe. And leave me a comment below. Let me know what you think. Until next time.